Hello, everyone. This is Sebastian McMahon from IA Financial Group. Back with another weekly economic review, this time for the week ending February 4th, 2022. So Omicron is still causing some volatility in the markets and in economic data, but we're looking at the markets right now, and I'll share a few reasons why it's an environment where if you have the long-term investment horizon, it's a very good time to be active in your portfolio, to put money at work, and 2022 should be a good year for active management. So more on that in a few minutes. So let's start right now with an overview of the economic data. All right, so lots of volatility again this week. Probably read the news that on Thursday, the NASDAQ was down by the most since March of 2020, but still after 4 days, the NASDAQ is positive this week. Now, as I'm recording this, it's Friday morning prior to market open. I don't see any clear direction in the market, so let's see where we end the day, but the beginning of the week was pretty strong. Now a bit of weakness towards the end of the week, so lots of volatility right now, but year to date, negative on bonds, negative on the stock market, and in other markets, the price of oil touched $90 for the first time since I believe it's 2014, so almost 10 years now. So a lot of strength on the price of oil. Canadian dollar was higher through the week, a bit weaker this morning because of the jobs data in the US that came out very strong, pushed the US dollar higher. So again, lots of volatility. We'll discuss that in a minute, but euro up, price of gold higher. So an interesting market indeed. Now, if we look at Omicron, so it's a record-shattering wave. These are the officially reported numbers, but we know that this probably grossly underestimates the real actual number of cases around the world. So these are world data, 7-day moving average. Now, this wave eclipses all of the other waves that we've experienced since the beginning of the pandemic, but we're pleasantly surprised at how resilient the global economic data has been through this wave. And here, just looking at the economic surprise indices, so you have developed countries on the left, you have emerging countries on the right. So the way this is calculated, this comes from Citigroup, the bank in the US. They look at the consensus of economists for all of the data points that are published through the week, and there's the data points coming out every single day around the world. They look at how the data comes relative to expectations. So if it's a beat, it's positive. The bigger the beat, the more positive the impact on the index. And as you can see, we've been going higher and we've been rather stable through the Omicron wave. So the global economy is taking Omicron in stride. So that's a good thing. But it doesn't mean there's not volatility in the data. So today we had the jobs data in North America. So a big upside surprise in the US. Consensus was for a slight creation of jobs. Recent forecasts of the last few days were more tilted towards a loss of jobs. And finally, we got 467,000 jobs added in the US, which was very strong. In Canada, we had minus 200,000 because of the restrictions that were put in place throughout the month of March, especially in Quebec and in Ontario. But we're still above pre-COVID levels for jobs in Canada, slightly now, but still above. And in the US, we're still in catch-up mode. So that's very interesting. But because of the way that these stats are officially compiled in the US, for example, you count as a worker if you worked at least 1 hour over the 2-week period of the period that was surveyed. So with Omicron, with the COVID, depending on when you miss work, it can lead to some volatility. So that's probably why there was strong upside revisions also to the last few months because of how these job numbers have been compiled. But I mean, if you want to have something that's more realistic, well, it's good maybe to look at hours worked. So on the left, you have Canada. On the right, you have the US. So as you can see, in January, the number of hours worked was down in Canada quite strongly, and in the US slightly. So even though jobs were added in the States, the number of hours worked was down. So it all depends on the mix. But still, Omicron is having a slight impact, bringing some volatility, but it could have been much worse when you look at the number of cases on the chart that I showed at the beginning. So financial markets now. So I'm bringing back this chart here. I used it last week, but this time is as of the end of the month, as at the end of January. So the spread in sector performance in January was historical. I mean, that was one of the largest in history. When you look at technologies, minus 20.4%, and energy plus 12.5% in 1 month. So that's the spread of 33%. That's one of the largest in history, and that's the rotation from growth to value. It's on, it should continue in 2022, and the value of active management takes its full meaning. So, I mean, just to use an old adage, it's not as much a stock market now as a market of stocks. So picking the right names, picking the right sectors, picking the right regions will be very, very important in 2022. And in the funds that we manage, we've been shifting managers around to have the exposure to the right styles. For example, in the selection funds, we moved from within the US from more growth towards much more value oriented. In focus, we did the same thing by shifting the weight of managers around, introducing new managers in selection. So we did all of these things to all of our funds to make sure that we're exposed to the right team. So that's the value that we add with our active management. We see that and we rebalance everything for you in our managed solutions. Now we're entering our RSP season, and so usually there's a lot of your clients that are putting money at work now. Well, timing the bottom is never easy. If it was easy, I mean, the streets would be filled with millionaires. But if you look at the worst Januaries in the history of the S&P 500, so they're all listed here. 2022 is about number 10 here in this table. Well, when you're very negative in January, in February, you tend to have some more volatility. So it's only 1/3 of the time that market is up in February following a very bad January. But if you look at the final 11 months of the year, so including this month of February, well, it's 2/3 of the time that it's higher, and you typically have some 2/3 of the time you have some good returns. So a median of 4.5%. So timing the bottom is never easy to do. I mean, it's almost impossible to do. But if you keep a long-term horizon, it tends to pay off. And another way to look at it is when you look at historical corrections of 10%. So since 1950 here, so you have over 70 years of data. If you buy after the S&P 500 is 10% off its high, so we did have this kind of correction, the high on January 3rd. After that, we went down more than 10% on the S&P 500. Then we rebounded a little bit, but we're still in the correction because we haven't regained the high. So when you buy after a 10% high, you have the blue sticks, and unconditional, just buying at any other time, you have the gray sticks. So after 1 month, after 3 months, I mean, you might have a slight hedge or no hedge by buying at the bottom or after a 10% correction rather. But if you start to look 6 months ahead, 12 months ahead, then you start to see the value of buying when things are cheaper. So the moral of the story is if you liked stocks in December, you should like them much more now. Many things are on sale. If you can take the volatility, if you invest for the long run right now, putting money at work, rebalancing your portfolio makes a lot of sense. So what to watch next week in the US? We'll have inflation, should be higher from 7.1 to 7.3, as the consensus is that the peak will be the next month. I mean, we're kind of in a peaking process here. Towards the end of the year after, we should have a slowdown. If we look at all of the leading indicators that we look at pointing towards a slowdown, and we'll have the University of Michigan Confidence Index should be a little bit higher. So very interesting index to see how confident US consumers are. So that wraps it up. ia.ca/economy. You can follow us there. Economy and Finance 101. Some new content will be published in 2022. You can visit that if you haven't done so already. And you can follow us on Twitter and on LinkedIn, especially LinkedIn if you want a copy of this PDF presentation. So thank you very much for following us. It's always a pleasure to serve you. And I'll be back again next week with another edition of the Weekly Economic Review.